Here's a question that's going to make some of you uncomfortable. What if the reason you're not building wealth faster has nothing to do with which investments you're choosing, and everything to do with the order in which you're making financial decisions? Because there is a sequence, a specific, mathematically optimal order for deploying your money. And most people are skipping steps 2, 3, and 4 entirely, wondering why step 7 isn't working. Let's start with something that sounds almost insultingly basic, but bear with me because the numbers here are genuinely alarming. A huge portion of people who are actively researching investment strategies, people watching videos like this one, reading financial articles, downloading budgeting apps, are simultaneously carrying high-interest debt. Credit card balances charging them 20, 22, sometimes 26% annually. And here's the brutal mathematical reality of that situation. The stock market, historically, returns somewhere between 7 and 10% annually over long periods. That's before taxes, before fees, before inflation adjusts those gains down to something more modest. So if you're carrying a credit card balance at 22% interest, paying that off isn't just a debt management strategy. It is, functionally, the single highest returning investment available to you. Guaranteed. No market volatility. No inflation risk. A guaranteed 22% return, which, for context, would put you in the company of the most elite investors in human history if you could achieve it in the market consistently. Yet people ignore that guaranteed return to chase uncertain ones. That's not investing. That's gambling with a handicap you chose yourself. But here's where this gets nuanced, and why the just pay off all debt before investing advice is actually incomplete. Not all debt is created equal. There's a threshold, roughly around 7 to 8%, where the calculation starts to shift. Debt below that threshold becomes a genuine judgment call, because historically, the market can reasonably be expected to outperform it over long periods. Debt above it? That's financial quicksand, and you need to get out of it before you can build anything meaningful. Before we even get to debt, though, there's something that has to come first. And I know, the moment I say emergency fund, half of you are already mentally checking out because it sounds like advice your parents gave you in 1987. But here's why this matters in a way nobody explains properly. An emergency fund is not primarily a financial tool. It's a psychological one. Without it, every market downturn becomes an existential crisis. Every unexpected expense forces you into one of two terrible decisions: liquidate your investments at the worst possible time, or reach for high-interest credit. Either way, an emergency derails your entire financial trajectory. With an adequate cash buffer sitting in a high-yield savings account, you can watch the market drop 30% and do absolutely nothing, which, historically, is exactly the right move. The practical question is how much? The traditional 3 to 6 months of expenses guidance is technically correct, but nearly useless because it doesn't tell you where you fall in that range. Think about your income stability and your replaceability in the job market. A tenured professional in a specialized field with rare skills has a very different risk profile than a contractor in a cyclical industry. The former might sleep fine with 3 months of expenses. The latter probably needs 6 or more. Start with $1,000 as your initial target. That covers the vast majority of actual emergencies people face. Then build systematically from there. Now here's where I need you to pay close attention, because this is the piece that most financial content either glosses over or gets completely wrong. If your employer offers a retirement plan match, you need to capture that match before aggressively attacking high-interest debt. Even credit card debt. I know that sounds counterintuitive, so let me walk you through the math slowly. An employer match is, structurally, an instant 50 to 100% return on your contributed dollars before those dollars even touch the market. If your employer matches 50% of contributions up to 6% of your salary, every dollar you put in becomes $1.50 the moment it's deposited. No investment on earth offers a guaranteed 50% immediate return. Even against credit card debt at 22%, the employer match wins in year 1. Every single time. The strategic move is precise. Contribute exactly enough to capture the full employer match, not $1 more at this stage. Then redirect everything else toward eliminating that high-interest debt. Once the debt is gone, you open the throttle on your retirement contributions. This sequencing means you're capturing a guaranteed windfall while minimizing the time you spend paying predatory interest rates. One caveat worth understanding. Employer matches often come with vesting schedules, meaning you have to stay with the company a certain number of years before those matched funds are legally yours. Know your vesting timeline. It rarely changes the calculus. The match is usually still worth it, but it's information you should have before making decisions. Once you've stabilized your foundation, emergency fund, high-interest debt eliminated, employer match captured, you enter what's genuinely the most powerful phase of wealth building available to ordinary people: tax-advantaged accounts. The reason this matters so profoundly comes down to compounding. When your investments compound inside a tax-advantaged account, every dollar of gains stays in the account and keeps growing. In a standard taxable account, the IRS takes a cut of your dividends every year, a cut of your gains every time you sell, and those extracted dollars stop compounding permanently. Run that difference out over 25 or 30 years, and the gap between the two scenarios can easily reach hundreds of thousands of dollars. Not from different investment returns, but purely from the structural difference in how taxes are applied. The sequencing within tax-advantaged accounts matters too. Most people assume they should maximize their employer's 401k first. But for many people, prioritizing an IRA before going beyond the employer match in a 401k makes more sense. Because IRAs typically give you access to a much wider universe of low-cost investment options. Many corporate 401k plans are stocked with expensive, actively managed funds that charge fees capable of quietly consuming a significant portion of your long-term returns. An IRA lets you access index funds with expense ratios that are a fraction of a % annually. That difference, compounded over decades, is substantial. The traditional versus Roth question is genuinely complex, and anyone who gives you a one-size-fits-all answer is oversimplifying. The core logic is straightforward. Traditional accounts give you a tax deduction now, and you pay taxes on withdrawals later. Roth accounts give you no deduction now, but withdrawals in retirement are completely tax-free. If you're early in your career and currently in a low tax bracket, Roth is almost always the right call. You're locking in a low tax rate on money that has decades to grow. If you're in peak earning years and a high bracket, traditional often makes more sense. When genuinely uncertain, splitting contributions between both types buys you flexibility and optionality in retirement, which has its own value. There's one account type I haven't mentioned yet that deserves its own moment because it is genuinely remarkable and genuinely underused. The health savings account, the HSA, is structurally unlike any other savings vehicle that exists in the American financial system. Every other tax-advantaged account gives you either a tax benefit on the way in or on the way out. An HSA gives you a tax deduction on contributions, tax-free growth while the money is invested, and tax-free withdrawals when used for qualified medical expenses. That triple tax advantage is unique. Nothing else works that way. The strategic approach that makes HSAs extraordinarily powerful is to treat the account as a long-term investment vehicle rather than a medical checking account. If you can afford to pay current medical costs out of pocket, let your HSA funds stay invested in the market. Save your medical receipts. There's no expiration on reimbursement, and years later, you can pull those funds out tax-free while your invested balance has had time to compound. It's a completely legal form of tax arbitrage that very few people take advantage of. Only after you've worked through every tax-advantaged option available to you does it make sense to direct money into standard taxable investment accounts. At that point, Those accounts offer something genuinely valuable: flexibility. No contribution limits, no withdrawal restrictions, no penalties for accessing your money before a certain age. If you're planning to retire early, these accounts are essential because they bridge the gap between when you stop working and when you can access retirement accounts without penalty. Here's the broader point I want to leave you with. The optimal sequence: emergency fund, high-interest debt, employer match, IRA, HSA if eligible, then maximize the 401k, then taxable accounts, isn't exciting. It won't generate the kind of dopamine hit that comes from buying a stock that doubles in a week. But it is, mathematically and structurally, the most reliable path to building real, lasting wealth that's available to people without insider access or inheritance money. The investors who actually achieve financial independence aren't usually the ones who found the best stock picks. They're the ones who followed the right sequence, stayed consistent, and let time and compounding do the heavy lifting.